Gold looking pretty bright. According to Citigroup, gold prices could crack $2,000 an ounce in the next 2 years. The bank commodities research team points to low interest rates around the world, mounting recession fears, and geopolitical uncertainty for the potential rise in demand. Joining us now is Aakash Doshi, Research Commodities Director at Citigroup. It's good to have you here.
Alexis, thank you for having me.
So this $2,000 price target, are you baking in a recession happening somewhere in there to spark that rally to bring the price there?
I think that's a part of it. So I think at least a rising risk of a global and U.S. recession over the next few years as we're very late in the business cycle. And we think in that environment, if you look yesterday, the Fed had a hawkish 25 basis point cut. The policy rate is now between 1.75 and 2%. I still expect there's a chance of a cut before the year is out, probably in the December meeting. That's at least where the market is still pricing Fed policy for this year. So when you're right around that 1.5 to 1.75% range, what happens when the business cycle turns in the U.S.? What happens if you do have a manufacturing recession globally spread into the U.S. consumer with the trade tensions being so high? And what if you have data start to roll over? Then I think in that environment, you could have the Fed go back to zero very quickly. And that would be in line with what other central banks are doing globally. So we think this theme of central bank convergence, of very low rates, of very accommodative monetary policy, and potentially even negative real rates persisting for a longer time is a benefit for gold as a long duration but zero coupon asset. So
you're saying that you're expecting one more rate cut before the end of the year?
That, I think, is highly probable, at least based on current market pricing. And certainly if we get a slowdown in some of the consumer data, which are lagging, but certainly on some of the leading indicators, if they rolled over the next couple of months, we do think that's possible in December.
So what does another rate cut in 2019 do to the price of gold? What's your outlook for Q4?
So for Q4, we actually think prices could rise as much as $75 an ounce versus current levels, which are at $1,500.
Okay.
So we think by year end, we could be kind of in a $1,550 to $1,600 an ounce range. We think it's remarkable of how well gold has held up even over the last 24 hours, because like I said, it was a hawkish 25 basis point cut. Chair Powell did not continue to say guarantee a rate cut, but he didn't rule it out either.
Right.
And remember, the Fed is not the only central bank game in town. Earlier this month, you had the ECB cut policy rates, and they're embarking on QE. The SNB in Switzerland, they're at negative policy rates. They've slashed their inflation outlook. You now have negative bank deposit rates in much of Scandinavia and in Switzerland as well. So I think these are ongoing concerns where gold looks quite attractive. But it's not just the interest rate story and central bank convergence that's driving this bullish gold outlook. It's actually that the central banks in the official sector are buying gold at a record pace.
That's
right. So I think this longer term trend of de-dollarization, of reserve diversification from the official sector, driven in part by U.S. sanctions policy, perhaps driven in part by trade tensions, but also for diversification reasons, for reduced credit risk that gold has. You're seeing a record amount of central bank buying activity for bullion this year, as well as last year. And we think that's a trend that's going to continue.
What could pour cold water, though, on this sort of gold fever right now? Could it be trade talks? We actually come to a deal?
Yeah, so the two risks that I highlighted in that note from earlier this month, which got a lot of headlines, was if you had a very hawkish turn from the Fed and other central banks, or two, if we get a surprise trade deal. So if we get a surprise trade deal and manufacturing activity and trade activity rebounds globally, and the global growth story doesn't look as weak for 2020 as it does currently. Keep in mind the OECD just cut global growth again today to a very
2.9% from 4%. Still good, but they cut it nonetheless.
Exactly. So at least the risks are there. So I think in that environment, maybe you argue that 1550 was the cyclical peak this time around. But the key level that we're looking for is 1375 to 1400. If that holds, those were 6-year highs that were breached in June where we called for a regime shift for gold. As long as those levels hold, we think actually there's still going to be a lot of buying interest. I don't want to get too detailed or technical, but if you look at the options market for gold, for example, things like call skew and volatility term structure are very bullish for gold right now. It suggests that there's a tail risk demand for gold from the investor community, and that people are generally still positioned for upside, similar to how we were in 2009, 2010,
Right.
when gold prices were rallying towards their nominal price peaks.
Just quickly, if somebody wants exposure to gold and they don't really have it, is a gold ETF a good way to do it?
So gold ETFs are definitely one way to get exposure. And what's interesting about gold ETFs is they tend to be physically backed. However, you can also have exposure through buying bullion, physical bars through dealers. You can also have exposure through the derivatives market, which is how a lot of institutional investors get exposure to gold, either through over-the-counter derivatives or through futures, like on the COMEX exchange, or from London or Shanghai futures as well.
All right, Aakash Doshi, thanks so much for making the case for gold.
Thank you for having me.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.